All right, there's a number of people that have already joined, and I see some others popping in, but for the sake of being prompt, we're going to go ahead and get started. So thank you for coming and joining us today. My name is Nick Murphy, for those who don't know, with Counterweight Private Wealth. Before we get started, just a couple quick items. One, quick disclaimer, this is information purposes only. It's a lot of great factual information, but don't take something you hear today and enact that in your own situation, really without talking to someone who's an expert about your specific situation. For clients of ours that are on this call, what I'd suggest is please don't do any type of claiming strategy unless we do talk to you. We'll run a very customized scenario and analysis for you and your situation so that you can make the best decision possible. And then lastly, we've had a lot of questions about whether this will be recorded. Yes, it will be recorded. The video will be available on our YouTube page at Counterweight Private Wealth. If you just search up Counterweight Private Wealth in YouTube, you should find it. It should be there probably in the next day or so. If you want to subscribe and then hit the notification bell, you'll be notified when that video is uploaded. So without further ado, I want to introduce Steve Swierkowski. For those who don't know him, Steve is our senior wealth advisor here at Counterweight Private Wealth. Steve is someone who he's an RICP, which is a retirement income certified professional. He's also a certified financial planner, CFP, and I call him our chief Social Security nerd because he nerds out on it. He really is an expert. He's the kind of guy that literally, when he goes to bed at night, will listen to a podcast and be like reciting things about full retirement age and primary insurance amount, all that stuff in his sleep. So he's a wealth of information. We're super glad to have him on the team and here today. So at this time, Steve, I'm going to let you run with it.
Okay, great. Thanks, Nick, for the introduction. I appreciate it, and welcome everybody to the webinar. And hopefully in the next 35 to 40 minutes, we can go through a good overview of Social Security and provide you some good information. Here's an agenda we're going to follow for the presentation. Here's our standard disclaimer. So Social Security first was enacted in 1935. It was designed to give retirees some form of retirement payment. Of note, the people that first started Social Security, they didn't necessarily pay into the system, but they were able to benefit from the program. When Social Security was first enacted by President Roosevelt, the initial full retirement age at that time was 65. In 1939, the program was expanded quite a bit to include benefits for spouses. Traditionally back then, there was one primary breadwinner. The other spouse stayed at home to raise the family. Well, so in 1939, benefits for spouses were included, and that was 50% of the workers' benefit can be provided to the spouse. Also provided for children and survivor benefits. So what are some of the things that people want to know about Social Security? The big one is, will it be there for me? We hear that Social Security is going bankrupt, something that I can't bank on. We're going to dispel some of those rumors. How much can I expect to receive? When to apply? Is it taxable? Can I work while I'm getting Social Security? And maximization. People want to know, hey, how can I maximize? And I think what Nick kind of alluded to earlier, it's not necessarily always a maximization question, right? It depends on your total portfolio and your retirement income strategy and where does Social Security fit in? Because it might not necessarily may be the best strategy to maximize. It may make sense for one person to start early and the higher earner to delay their benefit. But we'll get more into that in the presentation. And then next, will Social Security be enough for me to live on? Is that the one thing I can rely on to cover all my expenses? So will Social Security be there for me? This is a common question. This is something that you hear the pundits on the TV talk about. Social Security's going broke. We only got another 10 years left. It's going away. And what I'm here to tell you that's not That's not the case at all. So Social Security payments are made up of two sources right now. You have this huge trust fund balance. Think the baby boomers. When they were working, there was more people paying into the system than was receiving the benefit. So that huge surplus allowed the Social Security Administration to maintain a surplus via a trust fund. So you have the trust fund used to pay benefits. The second source is income that comes in through your FICA taxes. That's the Federal Insurance Commissioners Act. A worker pays 6.2% into Social Security, and the employer matches that with 6.2% as well. So you pay into the program, and current workers are paying into Social Security. So when you hear that Social Security is going broke, what's happening is the trust fund, remember that second source of funding current benefits, that is slowly being diminished as baby boomers now retire and start drawing from Social Security. We're starting to have to dip into that trust fund because there's not enough revenues coming in. So if you look at the fund balance from 2021 to the end of 2022, you see a slight reduction. Well, over the next 10 years, that reduction is going to continue. And then by about 2034, that trust fund is going to be eliminated if spending remains the same. And then benefits will be reduced to about 80% of current benefits unless Congress takes action to make some fixes. So what this chart shows is, if you see the blue line from the left, the year 2000, as we go to the right, in about 2034, you see that sharp drop of the blue line. What should happen is, if the program was fully funded, that blue line would continue where you see that darker gray line, and that would pay for full benefits for recipients. However, when that trust fund runs out, and without Congress taking any action, there's going to be a shortfall to pay out existing benefits. And that's where we see that we have this gap here that's highlighted. So there will be a reduction in benefit if Congress does not take action. Well, what can we do to restore the system? Well, first, I have full faith in the government that the system will be restored, right? In some capacity, it's going to be fixed. However, I do not see any fixes in the next 8 to 10 years, possibly. I think Congress is going to wait until the last minute because some of these changes are going to be unpopular among voters. So I really believe that they're going to wait until the last minute. And if you look at anything with that Congress has done with government spending and increasing the debt ceiling and things like that, they wait till the last minute. So I would anticipate some of this really picking up some steam in around 2031, 32 timeframe. What are some of the fixes to the system? Well, right now, only $160,200 of your income for 2023 is taxed for Social Security. Anything you make above that does not get paid into the Social Security system. So one fix is we can raise that cap and create more revenue that way. That would be a huge fix to the system. The second, we can raise the normal retirement age. Once again, if you remember in 1935, when the program first started, the normal retirement age was 65. In 1983, there was some act that raised the normal retirement age to 66. And then now the normal retirement age is 67. So you can see that that's slowly been raised, and it makes sense. People are living longer, higher life expectancies, so it makes sense to raise the full retirement age. Third fix may be to lower benefits. Once again, this would be highly unpopular. I don't necessarily see this, but it is something that is on the table. Means testing as well. Means testing would be that higher earning people that have more income coming in maybe would not receive Social Security. Once again, I don't see this as a viable thing that would be implemented, just because Social Security is a system that everybody pays into, everybody receives. So there's tremendous support for the system. And then 4, possibly reduce the cost of living adjustments. Social Security provides cost of living adjustment to their benefits. So you maintain your purchasing power, which is an important aspect of Social Security. And once again, I don't really see 4. I really see 1 or 2 happening as fixes for that shortfall in Social Security. So the bottom line for older workers, if you're, I would say 50 or older, I wouldn't anticipate any changes from current law. Congress tends to implement these changes in a phased-in way. For instance, in 1983, when changes were made to the full retirement age, those changes didn't take place till 17 years later and started in 2000. So they give people time to react to any changes because they understand the impact it has on people's retirement plan. So what's a clear way to think of Social Security? Well, to be honest, it's really one of the best annuities out there. An annuity is a payment that you get for the rest of your life. Great thing about Social Security is you do receive that actual cost of living increase, and it's guaranteed by the full faith of the United States government. So this is just an example of how the cost of living works. If you have a primary insurance amount, or if you're receiving $2,000 benefit a month, in 10 years, assuming a 2% cost of living increase, that $2,000 payment a month goes up to $2,438. And then you can see how it's impacted in 20 and 30 years as well. And this shows the cumulative benefit of receiving Social Security. And what I will tell you, for most people on this webinar, a $2,000 benefit in Social Security would probably be kind of low. I would anticipate most people on this webinar will receive considerably more than that in their benefit. And a little bit later, I'll go into what are some of the maximums. So how much can I expect to receive? Well, it's based on a couple of things. It's based on how much you earn during your working career and the age at which you apply for benefits. So Social Security will look at your highest 35 years of earnings. When they look at those 35 years of earnings, any year that you below 35 that you haven't worked, they just replace that with a zero. So if you've worked 20 years, you'll have 20 years of earnings history. 15 years with zeros will be included in figuring your benefit. They'll figure out an average index monthly earning. They'll divide it by some bend points, and then they'll figure out your primary insurance amount. And I'm going to go through an example here just to confuse you a little bit more. And the most important thing is the benefit is increased each year by that cost of living allowance. Before I go through an example, I just want to cover a couple of key terms here that are going to be used throughout the presentation. And I'm going to hit on these a little bit later as well. So the full retirement age is the age at which an individual may be entitled to their full or unreduced benefits. The next term is the primary insurance amount. This is like your baseline. This is the dollar amount that you receive when you reach full retirement age. And then most of the calculations you'll see, whether you're claiming early, claiming late, spousal benefit, survivor benefit, it's all based off of your primary insurance amount. A very important term. I'm going to put these definitions up again later in the presentation as well, because they are so important. So the full retirement age, remember I talked about how it was initially 65, then it raised to 66, and then slowly is increasing to 67. So anybody born 1960 or later, their full retirement age is 67. Okay, there's still some people that are being phased in that are still at the 66 and 6 months or 8 months or 10 months point. But you can see here they're born 1957, 58, 59. And the reason the area up here is highlighted in blue is because these people in that area highlighted in blue, 56 or earlier, they've already reached age 70, so they've already claimed Social Security. But for most people on this webinar, 67 is your full retirement age. And I'm going to kind of use that throughout most of the webinar as well. So here's the calculation. This assumes somebody is born in 1961. Their average indexed earnings are just over $10,000 a month, and that equates to about $125,000 in today's years. Just something to address. So Social Security, when they're figuring out your average index monthly earnings, they use something called a wage index to make sure that your earnings are calculated in today's dollars. So in 1980, if you made $20,000, that may be the equivalent of $60,000 today. They're going to adjust that by that wage index to come up with their average index monthly earnings. So when we look at the formula here, you'll see there's 3 bend points. The first bend point is 0 to 1,115. And then 90% of that is figured in the formula. And then you'll see between 6,721 and 1,115, 32%. And then over 6,721 up to the max 13,350, 15% of that is multiplied for a total of 3,350, 332. And what's important about this calculation, you don't have to figure it out. The Social Security Administration provides you a benefit estimate that'll do all this for you. But the important note here is that lower earners receive more of their income replaced in their benefit, right? So if somebody who's making only $1,000 a month, right, that's their average index monthly earning, they're going to replace 90% of that. So that's the important part. Okay, what are some of the maximums, right? So if you're making, once again, I said the Social Security wage base is only taxed up to $160,000 this year. That's adjusted for inflation. But if you're making somewhere between $150,000, $160,000, and you've made that for 35 years, your benefit for retirement age annually is about $43,524. And remember, I mentioned a spouse, even if they didn't work, they're eligible for half of somebody's primary insurance amount, which is the amount they receive before retirement age. So they can receive technically half of that. So all told, between the primary earner and the spouse, if they're claiming at 67, they're claiming, is it $64,000, $65,000 just in Social Security. That's a nice little addition. All right, so many people ask, well, why don't I just claim at 62? Why should I wait? Well, a theme that you'll see throughout the presentation is your benefit is reduced if you claim early, and early being before full retirement age. Whether it's your individual benefit, spousal benefit, survivor benefit, if you claim before your full retirement age, your benefit will be reduced. So when should I apply? All right, it depends on a lot of different factors. Health status and life expectancy. If you're single and you're 65 years old and you're going to pass at 70, okay, hey, it may make sense to claim early. Unfortunately, or fortunately, many of us just don't know when we're going to pass, so we have to make some assumptions. Do you need the income, right? Can we delay claiming? Are there any sources of income that we can use before claiming? Do you plan to work? And I'm going to cover that a little bit later on, that there are penalties if you claim before full retirement age and are still working. And then survivor needs. That's a huge aspect of the planning that we do. So once again, we talked about full retirement age. What is it? It's the age at which an individual is entitled to their unreduced benefit. Primary insurance amount, once again, baseline. Think of the primary insurance amount as the baseline, and that's the amount that an individual receives at their full retirement age. Okay, so remember, so at 67, I'm assuming somebody's born 1960 or later, their full retirement age is 67. If they claim at their full retirement age, they will receive 100% of their primary insurance amount, or that baseline number. Remember, there's penalties if you claim early. So if that individual says, you know what, I want to claim at 62, you can see if your full retirement age is 67, that top right corner, you're going to have a 30% reduction in your benefit. And that lasts throughout your whole lifetime. And that's why we say sometimes in claiming, your benefit is permanently reduced. If you claim early at 62, you're going to be permanently reduced.
Hey, Steve, could I just ask a quick question? Because we've heard before, all right, well, what if I took it at 62 and I'm like, oh man, maybe I made a huge mistake. Is there any way, is it irrevocable? Is there anything that anyone can do if they took it too early in their mind?
Yeah, that's a really good question, Nick. So if somebody claims at 62, they have a 12-month window or claims at 62 or 63 and feel that they've claimed early. They have a 12-month window to say, hey, I made a mistake. I didn't mean to claim early, and they can pay back all the benefits they received and then start over again. And then it's like they haven't claimed, but they have to pay back everything. The good news is the government won't charge any interest on that money they paid you. The other thing you can do, if you claimed early at 62 or 63, when you hit full retirement age at 67, you can suspend your benefit and then receive what's called delayed retirement credits. And I'm going to go into what those delayed retirement credits are. But that can only be done after age from 67 to 70. And you're still permanently reducing your benefit because you claimed earlier. So here are the delayed retirement credits I want to talk about. So Social Security dangles a carrot in front of you, and they want you to kind of delay claiming till 70. Right? So full retirement age, 67, you receive 100% of your primary insurance amount. Each year you wait after age 67, you get an 8% increase in your benefit. So if you wait 3 years between 67 and 70, your benefit will increase 124%. And that's for the rest of your life. So 70 for an individual benefit is where you maximize the highest amount. And just another note, delayed retirement credits, it only applies to your individual benefit. It doesn't apply to the survivor benefit, doesn't apply to the spousal benefit. You cannot receive delayed retirement credits there. It only applies to an individual's benefit. So this chart just kind of shows kind of the cumulative effects of claiming early or later. Assumes a 2% cost of living increase. Somebody's primary insurance amounts to $2,400. If they claim at 62, the cumulative amount at age 85 is $638,000. Whereas had they waited and claimed till 70, they get almost $811,419. Significantly more money. And then the longer they live beyond 85, that difference gets even bigger. It's even more of an advantage. So how can I maximize benefits? One, we recommend annually logging into the Social Security site. Make sure you establish and have an account set up there and download your statement. Make sure that your earnings history is correct. They'll have your whole earnings history there. Just make sure that that's up to date and accurate. Make sure there's no missing years. And then just continue to work. The longer you work, the more you fill up those 35 years. And even if you have 35 years, if you continue to work and earn significantly more than the earlier year that's in your calculation, that lower earned year will be replaced with the higher earning year, and your benefit will be adjusted.
Okay, Steve, one more question, if you don't mind.
Sure.
So a lot of times people ask about that 35-year period. So if they've, maybe if it's taken over a 35-year average, what if they didn't work all of those 35 years? If there's a gap where they've had zeros, in 10 of those years or something, does that penalize you, or like how does that actually work?
Okay, yeah. So to have a Social Security benefit, you have to work at least 10 years. So 10 years is the minimum amount of time that you have to pay into Social Security to make sure you have a benefit. If you do not have a total of 35 years of earned income, those years are still included in the calculation. You just receive a zero, unfortunately. And that's where it pays to try to keep working. Do your best to try to get 35 years. But if you don't, Social Security just puts a zero in there, and it's going to ultimately lower your benefit. So good question. Okay, so applying for Social Security at the right time, it really depends on a full assessment of your income needs, life expectancy, and then really important too is your spouse's life expectancy and what is your spouse's benefit. And that comes down to the survivorship. So we do quite a bit of planning, and Social Security serves as a great foundation, but it's all part of one's total retirement plan. So next I want to cover taxation. These are a couple of things that are very widely misunderstood about Social Security. And with taxation, I'm also going to cover the withholding of benefits. And this one, withholding of benefits, people get this wrong all the time. So the bottom line here is, if you claim Social Security before full retirement age, some of your benefits may be withheld. Okay. If you work after full retirement age and you claim at full retirement age and work after, doesn't matter. The problem comes in is if you're 62, you're before your full retirement age, you're working, you're bringing in income. Social Security has something called a earnings test. And if you make too much, they're going to withhold some of that money. So you don't lose it. You know, I've heard people say, if I work and claim Social Security early, I'm going to lose it. Well, so why even claim it? You don't lose it. It's withheld and it's figured back into your benefit once you reach full retirement age 67. Now, you don't get the money back all in one swoop. It's paid out over your lifetime, right? So, you know, that's something to consider, but you do get the money back. Okay, next I want to talk about taxation. Just about for everybody on this webinar, your Social Security will more than likely be taxed. Okay, here are some of the tax thresholds to meet for taxation. It's important to note that taxation first started in 1983. President Reagan taxed up to 15% of it. He signed legislation into effect. And then in 1993, President Clinton then increased that to up to 85% could be taxed. This was initially, if you think back in 1983, these amounts were initially geared towards higher earners being taxed, creating more revenue. They didn't want to affect lower earners. However, this is one of the very few items that has never been adjusted for inflation. So these numbers that were set in 1983 are the same numbers we're using today. So what you see is more and more people are seeing their Social Security benefit taxed. So if you're married filing jointly and you make over $44,000 as a couple, up to 85% of your benefit's going to be taxed. The interesting thing about the way Social Security figures out that your provisional income is they take your adjusted gross income from your tax return, they add in half of your Social Security benefit, and then they also add in any type of tax exempt or municipal bond type income into the formula. So at the end of the day, most people, especially because as they have Social Security, they have other income coming in from required minimum distributions from 401ks and from IRAs, count on Social Security being taxed. How do we minimize it? Try to reduce your income with tax advantage investments. One of the biggest ways that you can reduce it is perhaps doing some Roth conversions. That's something that we do quite often at our firm. The hard part about doing Roth conversions, you know, before you start claiming, before you start hitting your required minimum distributions, people have a hard time paying taxes now. They sometimes can't see the benefit, but it's worth it to convert to a Roth to reduce some of that taxable income down the road. And then just continuing to manage taxes throughout retirement, you know, via your CPA and your advisors, just working with them on a plan. Okay, the other thing I want to talk about is Medicare. When you apply for Social Security, your Medicare premiums are taken out of your Social Security. It's going to reduce your Social Security benefit by a little bit. So just something to consider. Here's kind of a chart of how that works. I anticipate most people would be in the, that first tier of the premium. However, when your income goes up, you may reach that next monthly tier and be paying higher premiums. Something to consider. Once again, go back to the Roth conversion strategy. Something we like to do a little bit earlier. This way you have less income coming in and you pay less in Medicare premiums. All right, so when to apply? Once again, the theme is if you apply before your full retirement age, you're going to have a reduction in your benefit, just something to consider. Consider those cost of living allowances and how they magnify the impact of that benefit. Taxes, something to keep into consideration. Earnings test, big thing, big takeaway from the earnings test is once you reach full retirement age, as long as you claim after that, you can make as much as you want, and it doesn't affect the earnings test. And then delaying benefits. When it comes to the survivor benefit, that becomes a big thing. Delaying enables the surviving spouse to get more money.
Hey, Steve, can we pause 1 second for another question?
Sure.
One, I think the chat's disabled, but there's a Q&A at the bottom. So if we have time, we'd love to get to some questions. One question we have, can you clarify if you elect to defer until you're age 70 to claim? Does that mean that your spouse has to begin taking at 67, either on any kind of spousal benefit or anything like that?
Yeah, I'm gonna cover into the spousal benefit here. I'm about to get into that in a little bit, and there's some rules there. But the spousal benefit is based on a worker's primary insurance amount, the amount they would receive at 67. So a worker delaying until 70 or claiming at 62 is not necessarily going to impact the spousal benefit. I'm going to cover that a little more in detail in some of these coming slides.
Great, thank you.
Okay. All right, so for couples, we typically recommend the higher earner wait until 70. Okay, I'm going to cover spousal benefits right now. And spousal means that, we have a primary worker that earned quite a bit of money. The spouse is now going to, who maybe has never worked, is now going to claim off of that spousal record. What's important to know here is that the primary worker must claim to trigger the spousal benefit. The spouse must be at least 62. Once again, the theme here is if you claim before full retirement age, you're going to have a reduction in benefit. So that spousal benefit, if they claim at 62, they're going to receive a reduced amount of the worker's primary insurance amount. I'm going to have a chart here that kind of explains some of this. Spouse's benefit, once again, it's based on the worker's PIA. It's not impacted if the worker claims at 62 or a really reduced benefit. That's not going to affect the spousal benefit. It's based on primary insurance amount. And then remember that 8% I talked about from 67 to 70? There is no delayed retirement credits for spousal benefits. And then the marriage requirement is 1 year. And once again, subject to the earnings test. So if you claim early before full retirement age and you're working, it is subject to that earnings test. So here's an example. And, with the examples, if I'm using the male as a primary earner, I'm not trying to alienate anybody. It's just the way these are. We have plenty of clients where the female is the primary breadwinner too. So, but for these purposes, I'm just using the male as the primary earner. So if Jack's primary insurance amount is $3,600, Jill has never worked. She stayed at home, raised the kids. Once Jack files for his benefit, Jill is eligible for that spousal benefit. And that's half of Jack's primary insurance amount, or $1,800. Okay, so this chart just showing again, 67, if the spouse, and I'm just going back to the previous example, Jack's primary insurance amount was $3,600, half of that $1,800. So if Jill decides to claim, I want to claim early at 62, her benefit's going to be reduced. At 67 is when she receives that full $1,800, that 50% of Jack's PIA. And remember I said there's no delayed retirement credits. You don't receive that 8% on the spousal benefit. So there's no benefit for a spouse to claim past age 67. Okay, it gets a little more complicated now if the lower earning spouse is entitled to Social Security on their record. The way it works is if that spouse, if the spousal benefit plus the other the lower earners benefit is included in the formula, best to go through an example. So once again, Jack's PIA was $3,600. So the spousal benefit total is $1,800. But Jill worked and she has a benefit record. Her PIA is $800. So if we look at the spousal benefit of $1,800, it's first made up of that individual's own record, Jill's own record of $800. And then there's something called a spousal add-on to get her up to $1,800. Where this gets a little bit tricky, this example is kind of clean, but where this gets a little tricky is where Jill may want to claim early. Jack waits a little bit later to claim, so he's never triggered that spousal add-on. And then how is the benefit reduced at that point? And there's an interesting blog post on our website, on our insights page that really goes into a detailed example on this. And I can really spend about 30 minutes on just that example. But just realize for a spousal benefit, the lower earning spouse, if they have their own benefit, that's paid first. And then the spousal add-on is on top of that to top them off to Jack's 50% of his primary insurance amount.
Hey, Steve, sorry, one other question. File and suspend, that's a concept that's obviously been out there a while, but what's the deal with file and suspend right now?
Okay, so yeah, it's a great question. So file and suspend used to be a strategy where somebody can like a higher earner can start his benefit, so the wife can claim a spousal benefit, and then the husband would immediately suspend it so he can maximize his benefit and wait to claim till 70. Well, Social Security kind of caught on to this, and there's a very small window of people that are still eligible to do this. Typically, if you were born before January 1st, 1954, you still may be able to execute this strategy. Very few people are still in that window, though. Social Security now has something that they've enacted called deemed. It's deemed filing, which means that when you go in to file for your benefit, you're applying for everything you're eligible for at that time. So they will not allow you to do that strategy anymore. It used to be very effective, but once again, that's kind of phased out. Very few people are still able to do that. But great question. Okay, next I want to talk about widowed and divorced. I got about another 5 or 10 minutes left, and then we'll open it up to questions. Survivor benefit, 2 key things. It's based on when the deceased spouse originally claimed the benefit. And this is why we typically always recommend that higher earner wait until as long as possible to age 70 to claim their benefit. It also depends on when the widow claims. So typically your age window to claim is typically 62 to 67, 62 to 70 for most things. For survivor benefits, you can claim as early as age 60. But once again, if you claim before your full retirement age, you go back to that theme that there's going to be a reduced amount that person receives. So let's take a look at this example. Joe and Julie are married. They're both over age 67. Joe's benefit is $2,800. Julie's benefit is $1,500. When Joe dies, Julie now assumes that higher benefit of $2,800. She'll lose her $1,500, but now she goes up to that to Joe's benefit, which was higher of $2,800. Here's an example of delayed claiming, right? So if Joe had a PIA of $2,800, however, Joe was smart, kind of waited until age 70 to maximize his benefit. He got those 3 years of delayed retirement credits, 8% per year. that $2,800 PIA now went up to $3,472, and that's the amount that Joe's going to get because he waited till 70 to claim. Well, if Joe dies at age 72, shortly after receiving his benefit, Julie now gets the benefit of receiving that $3,472, that higher benefit for Joe. She doesn't go back down to his PIA of $2,800. She's able to assume that higher amount with all those delayed retirement credits. Once again, showing the importance of the higher earner delaying claiming till 70. So what are some of the rules? Couple must have been married for a certain amount of time, for at least 9 months. For the survivor, remember I said you can claim as early as 60. We don't recommend it because you're receiving a reduced amount. It's better for that survivor to wait until full retirement age. Survivor benefit, an interesting fact here is if the spouse claiming the survivor's benefit remarries after age 60, she can claim on her previous spouse. So she or her new spouse. If let's say Julie was married to George, George passed away at 55, Julie remarries at 61 to Sam, Sam passes away, Julie, because she remarried after 60, can choose either George or Sam's survivor benefit, whichever is higher. For divorced spouses, divorced spouse can also receive a survivor benefit as long as the marriage lasted for 10 years and that the divorced spouse never remarried. This chart just kind of shows some of the cumulative effects. The first kind of set of numbers. So if Joe claimed at 62, right? And I want to go to Jane. I just want to go down to age 67, the left of the chart, the bottom line. If Joe had claimed at 62, or Jane's benefit would only be 1,980. Whereas if Joe claims at 70, Jane's benefit at her full retirement age would be 2,976. That's quite a big difference and makes quite a big impact in somebody's life. Just the key points about survivor benefits. If Joe dies, his benefit stops. So if you have two people relying on Social Security, just remember that one of those benefits are going to stop. Surviving spouse is entitled to a survivor benefit equal to the deceased spouse's benefit, right? Now, what if the surviving spouse's benefit was more than the deceased spouse? Then that person just maintains their own benefit because it's higher. Here's some other points. So once again, survivor benefit, you can claim as early as 60, but it's going to be reduced. 67 for that survivor is the max. There's no benefit for that person waiting after age 67 to claim a survivor benefit because you do not receive the delayed retirement credits. And then once again, if the widow's own benefit's higher, the surviving spouse, they just keep their own benefit. Okay, divorced spouses, and this is one of the last slides, so we're coming close to the end. Interesting points here. So the marriage just has to last 10 years or more. The person receiving a divorced spouse is currently unmarried, and the ex-spouse, the person who you're claiming, whose record you're claiming on, is at least age 62. And then the last bullet was just put in there: if divorce was more than 2 years ago, the ex-spouse does not even have to have filed for the divorcee to claim. They didn't want anybody, being spiteful or anything, so they put that in there to allow the divorcee to file on somebody's record. Some of the rules. One of the more interesting things with Social Security is you can have more than one ex-spouse claiming on your benefit, and it's not going to impact any of your current individual benefits. So let's just say Sam was married for 10 years in his 20s, married again in his 30s for 10 years, in his 40s. So he's got 3 ex-spouses, gets married again now. As long as those 3 previous 3 ex-spouses never remarry, once they hit the right age, 62 to 67, all 3 of these can claim on that ex-husband's record. And then his current family can still have the spousal benefit, and he can have his own benefit as well. Kind of an interesting thing about the Social Security. I just want to cover briefly what Social Security can and can't do. So, if you're going in to seek advice from Social Security, they can tell you what your benefit is. If you're a divorcee, they can tell you what the PIA of your ex-spouse was, right? So you can do some planning. What they can't do is give you claiming advice or some different strategies and scenarios, right? That's not their job. That's not their charter. They don't know your overall financial picture. So don't go in there and just say, hey, here's where I'm at. What do you think? They can't by law tell you what to do. So that's really incumbent upon your financial team, your CPA, to kind of give you some advice about claiming. Here are some resources out there. Remember, we talked about your Social Security benefit and checking your earnings record. That's that socialsecurity.gov My Account. You can also log in and check out Counterweight Insights page, where we post some articles and blogs about Social Security. Then you can always contact myself or Nick with a question about Social Security. We do have some pretty elaborate planning software that we can use to see what your benefit is and show you some different scenarios and claiming strategies and really take a look at your whole financial picture to see where Social Security fits in. So this is what a benefit statement looks like if you have an estimate. If you log on to the site and you download it. Remember, we talked about bend points and trying to figure everything out. Well, you don't have to do that. Social Security does it for you, and it will show you your estimated payments. Some of the things to consider, though, there are some shortfalls here. This assumes that you keep working and you're earning as much as you did the previous year, which may not be the fact for some people if you retire early. There's also different ways that they use the COLA when they figure out stuff. So, but a good starting point, at least you can get an idea of where your benefit will be. Some of the key takeaways, when it comes to Social Security, I'm a huge fan. I love it. I think it forms a great foundation for your financial plan. Do I think there'll be fixes to make sure that we can continue to pay out 100% benefits? I do. I just don't see those changes taking place anytime soon. I think Congress will continue to punt the ball down a little bit, and maybe when we get to 2032, 33, then they'll start getting serious about some of the changes that we talked about earlier on. Social Security, while it was never designed to pay for everybody's total expenses in retirement, just realize it is a solid foundation. It replaces kind of like that steady paycheck you were receiving from work. Very good system. From a financial planning, we like to use these words: longevity protection, inflation, default risk protection. Nothing better than Social Security when it comes to those risks. Once again, the theme, remember I talked about claiming early permanently reduces your benefit. So really give careful consideration if you're going to claim before your full retirement age. Claiming with your spouse, strongly recommended because of the survivor benefit aspect. And then claiming strategies, they do become a little bit complex. And once again, that's where we come back to some of the different software that we have access to, that we can run some different claiming strategies and see how it fits into your overall financial plan. And with that, I appreciate everybody sticking around. It's about 50 minutes of Social Security. I know it's a lot for some folks. I mean, as Nick mentioned earlier, I kind of dig this stuff. I really enjoy it. And I feel it's a super important part of everybody's financial plan, and you should really give careful consideration in how you claim Social Security. So with that, I'll just turn it over to Nick, see if there's any other questions.
Thanks, Steve. So for the sake of everyone's time as well, we know that we do want to be somewhat brief, but we do have some questions. If you have questions, there's a Q&A at the bottom of the webinar here. Just move your mouse or something, and you should be able to see Q&A, and you can type your question in there. A couple questions that have come in, Steve. So One, Medicare and Social Security are often very linked together, even though they're different programs and such. Um, can you turn down Medicare if you have another health plan? And does that affect Social Security at all? And again, that's a little bit more of a Medicare question, but do you have any insight on that?
Yeah, and that's once again a good question too. And to be honest, we can do a whole nother webinar on Medicare because it is pretty important. But Medicare at age 65 becomes the primary payer, right? So unless you have a healthcare plan where you're continuing to work past 65, you have 20 or more workers, Medicare becomes your primary Medicare or medical expense, medical insurance. So like I said, unless you're working for another company that has over 20 employees and are covered by their plan, only then can you delay signing up for Medicare. If you work for an organization with 19 or less people, or you're not working anymore and you fail to sign up for Medicare, when you go to get medical help or assistance, they're going to charge Medicare first. If you don't have Medicare, they're going to come back and charge you. So you have to sign up at 65.
The other thing that's I think important to note, Medicare Part A and B, if you don't sign up at 65, there could and are usually penalties assigned for not signing up at that time. So even if you do have another plan, you need to go through the process of signing up. And again, Medicare is a whole nother animal. Get specific advice to your situation on that. Another question. So this has to do with a spouse that is significantly younger. So let's suppose that someone has a spouse that's 14, 15 years younger or so. And so should the primary worker who is older wait until 70? But like, what if they die before they're 70? Does the primary worker that passes later, will the spouse get the full benefit at 67? Maybe just real quick touch on that.
Okay, yeah, no, that's a great question too. And I apologize for not covering that. So if the higher earner is delaying claiming to increase their benefit and provide the maximum survivor benefit, if they pass at age 62, right, they haven't reached full retirement age, they haven't reached 67. So that benefit, if you pass at 62 and have not yet claimed, the survivor benefit will be bumped up to your primary insurance amount, your actual primary insurance amount. If you pass between age 67, your full retirement age, and 70, when you're getting those delayed retirement credits, the survivor benefit is going to be based on your day of death. So say you pass at 68, you got 8% more in your retirement credit, you're going to get 108% of your primary insurance amount. So good question. Even if your spouse is younger, it really pays to have, wait till 70, really maximize that survivor benefit. Now, that spouse may have to wait longer to claim because we want to make sure they're at 67 to get that full survivor benefit. But there may be other ways to fill that gap before she claims. And that's something that really, it's really important to meet with a financial advisor just to see how you're going to fill that gap between when you pass and before your spouse claims.
Okay, good stuff. This has to do with kind of integration with federal retirement benefits. Mm-hmm. And again, this doesn't apply to everybody, but maybe speak about if you know of anything about the federal retirement benefits where you don't have Social Security. How does that impact maybe a spousal benefit and such?
Sure. No, that's a good question too. So there's something called a government offset pension or and a windfall elimination provision. So the windfall elimination provision is if you are a federal employee and you didn't pay into Social Security, then you may be subject to that where you don't receive your full Social Security benefit. I'm not sure the exact time, but I think it was like 1983 or after. If you were a federal worker, you're not impacted by it. You paid into Social Security, it's not going to affect your benefit. If you were a federal worker before 1983, then it's something that may be considered. Might be something. Just reach out to us and we can do some calculations. But basically, to receive Social Security, you had to pay into the system, right? So there are some people that can opt out, right? If you're a clergy for religious reasons, you can opt out of Social Security. Now, I mean, I wouldn't recommend that. I think Social Security is great, and I think it's worth paying into and getting the benefit because I think people that opted out, they regret it, I think, for the most part.
Sure.
But
great.
In short answer, yeah. I mean, it may. If you were a federal worker before a certain period before, I think 1983, then it may be an impact.
Okay. Great. I think that's all the questions we had submitted. Again, if you do have questions and want to reach out to us, please feel free. Reach out to Steve or myself, or just go to our website and hit the contact us. Steve, thank you very much. Hope all of you kind of realize that he's a wealth of information on this, and it's a huge asset to have at our disposal. So thank you very much, Steve. We appreciate all of your time today. If there's anything we can do for you, please reach out to us at any time, and hope you have a great day. Thanks.